In the financial markets, most retail traders fail for one primary reason. They trade purely based on price derivative indicators. They look at moving averages, RSI or MACD, which only tell you what has already happened. Price shows you what occurred in the market, but volume reveals who caused it and how much conviction was behind that movement. If you want to develop genuine trending patience and stop getting chopped up in fakeouts on the S&P 500, Nasdaq, or individual equities, you need to understand the structural language of volume. Today, we are dissecting volume analysis through a professional lens, focusing on raw auction mechanics, institutional footprint, and actionable patterns. Step 1. Price versus volume. The anatomy of liquidity. Let's start with the fundamental difference between price and volume. Price is simply the last agreed-upon transaction value between a buyer and a seller. It represents advertising. Volume, on the other hand, represents the total number of shares or contracts traded during a specific period. It is the fuel that validates price action. Consider a real-world U.S. market case study on the SPY ETF during a high-impact FOMC event or earnings release. Suppose SPY breaks out above a major resistance level of $500 with a large green candle. A novice trader immediately enters a long position because the price is moving up. However, if you look at the bottom panel, the volume bar for that breakout candle is significantly below the 20-day moving average volume. This is a classical low-volume breakout, often referred to as a liquidity vacuum. Institutional algorithms, smart money, are not actively participating or putting capital behind this move. Instead, retail orders are simply filling the order book in a thin market. Without institutional backing, price quickly reverses, sweeps retail stop losses below the resistance level, and crashes back into the range. Now, contrast this with a genuine institutional breakout. When SPY breaks $500 on volume that is 200% to 300% higher than the average, it indicates aggressive market orders, clearing out passive limit sell orders at the ask. Large funds, like Vanguard, BlackRock, or major hedge funds, cannot hide their order execution. Their multi-million-dollar flows leave an undeniable footprint in the volume profile. Price creates the narrative, but volume provides the truth. Step 2. Effort versus result. The mental model of Richard Wyckoff. To master volume analysis, you must adopt the mental framework established by Richard Wyckoff, the law of effort versus result. Effort is represented by the volume, the amount of trading activity, while result is represented by the price spread, the distance between the high and low of the bar. In an efficient market, effort and result should be in direct alignment. Large volume should yield a wide price spread. Small volume should yield a narrow price spread. An anomaly occurs when there is a stark discrepancy between effort and result. Let's analyze a case study involving Tesla, TSLA, near a key supply zone at $250. Imagine TSLA prints a wide-range green candle moving up 4% with massive volume. That is high effort producing a high result, completely normal. But on the very next day, TSLA attempts to push higher and prints a tiny doji candle with a very narrow body. However, the volume panel shows the highest volume bar seen in the last 3 months. Ask yourself, if massive effort, huge volume, was injected into the asset, why was the result, price expansion, so minimal? This effort versus result divergence tells you that institutional sellers are heavily absorbing all incoming buy orders at the ask. Smart money is utilizing retail enthusiasm to distribute their heavy long positions into strength without allowing the price to rise further. The moment absorption is complete, the market collapses. Recognizing this mental model allows you to stay patient and avoid buying right into institutional distribution. Step 3. Identifying critical volume patterns. Now let's break down 3 high-probability volume patterns that every professional trader must master: stopping volume, buying climax, and volume divergence. Chart 1. Stopping volume on E-mini S and P500 futures, ES. First, stopping volume. This pattern occurs at the end of a prolonged downtrend. Picture E-mini S and P500 futures aggressively dumping on negative macroeconomic news. As the market prints consecutive red candles, you observe a massive red candle with an extraordinarily long lower wick, accompanied by historic high volume. This heavy volume indicates that major institutional bid limit orders have entered the market, absorbing all the panic market sell orders from retail traders. The high volume stops the markdown phase dead in its tracks, signaling an incoming trend shift or consolidation. Chart 2. Buying climax on NVIDIA, NVDA. Second, buying climax. This occurs at the tail end of an extended parabolic uptrend, frequently seen in high beta tech stocks like NVIDIA, NVDA. After weeks of uninterrupted rally, NVDA gaps up massively at the U.S. market open on intense media hype. The price surges, printing a massive green bar on parabolic volume. Retail traders buy aggressively due to intense FOMO. However, this extreme spike in volume represents the final blow-off top. Institutions dumping their remaining inventory into retail buy market orders. The candle often closes near its low or forms a upper wick, marking the absolute macro top of the trend. Chart 3. Volume divergence on Nasdaq 100 futures, NQ. Third, volume divergence. This is the ultimate tool for practicing trending patience. Suppose Nasdaq futures, NQ, are making a series of higher highs on a 1-hour chart. Peak 1 occurs on high volume. Peak 2 makes a new price high, but on lower volume. Peak 3 makes yet another high, but on significantly declining volume. Price is advancing, but participation is drying up. This divergence warns you that the trend is running on fumes, and a sharp liquidation cascade is imminent. Conclusion and structural summary. Mastering the financial markets does not require complex predictive magic. It requires reading auction mechanics accurately. Price action tells you where the market has been, but volume tells you how healthy the underlying move actually is. By applying the law of effort versus result, tracking institutional absorption, and remaining patient until stopping volume or climax patterns confirm market structure, you shift your execution from guessing to analyzing conviction. Stop trading price in isolation. Integrate volume analysis into your framework. Observe institutional liquidity pools, and let the footprint of smart money guide your market participation.